Those that control the real estate control the world.
You're not supposed to use your money. You're supposed to use other people's money.
So when I have a rental property here, it puts money in my pocket. When I rent a property, I've done a good job buying it and structuring it. Every month it sends me money.
Hello my friends, I'm aware that everyone is interested in learning more about this topic. That is how to go about purchasing your first rental property. Check out this shirt. There's a ton of information to review where to begin. I'm going to walk you through what I did step by step. Also, what I continue to do. How I bought lots and continue to buy properties similar to that you're seeking. How much cash is actually required. The best way to ensure that it's a wise investment. If you can, click the like and subscribe buttons. This is how to purchase your first rental property. The first thing you must do is conduct a personal assessment of your financial situation. What is your credit score? What can you afford in monthly payments? How much do you have for a down payment? Also to have a prudent reserve for any sort of emergencies. Let's start with the down payment. Only for residential properties, ones that you'd be living in. In some jurisdiction, some lenders will accept 10% on as a down payment. I advise putting down at least 20% so that you avoid paying all the extra fees and higher interest rates. This could save you thousands of dollars, but it also helps with building equity for long-term wealth. We'll get more into that later. Therefore, you need to put down $20,000 of your own money for every $100,000 you're borrowing. If it was a personal residence, however, you might be able to put down much less. A larger safety net is created by having more money down. Additionally, lenders prefer to see more down than less. Whether or not you choose to invest in real estate will depend on how much money you have saved or plan to save. Therefore, saving up a sizable sum is essential. $2,000 is just enough for closing costs on a $100,000 property. It's not a down payment. The good news is that you can learn these guidelines while you save money, then put them into practice once you have enough. We therefore assume that you're either attempting to save for a down payment or you already possess the down payment. Unless you're purchasing the house outright in cash, which I suspect there are very few of you who are, most of us will need to obtain a loan for the property. To accomplish this, you must work on your credit rating, which indicates viability. If your credit score is about 550 and you have 2 credit cards and that's all you have, a possible late payment on them, or some bills in collections, you must attend to that first, prior to even considering investing in property right now. Ideally, wherever you go to obtain a mortgage, you must have good credit. A score greater than 700 is the least. 740 and above, ideal. If you want a better mortgage, then a score of 760 or more is fantastic. This will allow you to get the best mortgage rates available. If it is lower than 700, then you're going to be perceived as a risky borrower. And as a result, they increase your rates. So by having a great credit score, every day ends with more money in your pocket. So you'll want to possess any credit initially and a few active credit lines that you've never been late. Always paid off on time, preferably nothing in collections. If your credit score is greater than 700, you're good to go. If it is lower than 700, then you're going to have to deal with that first by ensuring that everything is fully paid off. If you have any late collections, make your payments. The next step, tax returns. I know, I don't like even talking about tax returns. I'm going to assume you've got decent credit and possess some money as a down payment through savings. You must submit your tax returns to the lender first. Whenever a lender examines you for a loan, they always request your tax returns, especially if you work for yourself, like me. They're going to examine my last 2 years, maybe even the last 3 years worth of tax returns. And between those 2 years, they will take the average. An example, let's say 1 year you make $80,000 and year 2 you make $100,000. That means you earned $180,000 over 2 years gross. So you'd be able to qualify for the average, which is $90,000. Next, they're going to want to see between 2 to 6 months worth of bank statements, evidence of employment, evidence of income, pay stubs, evidence of any additional debts or assets. It is key to ensure that you have everything. so as not to waste time. Being self-employed and writing off lots of stuff can hurt you in this process, as the net income will be looked at. So don't be the cool guy because you earned $100,000 annually, but you deduct $80,000 of that per year in trying to reduce your tax bill. It will only hurt you with lenders. Prior to purchasing a home, what I usually do is I cut back a little bit on my business expenses. I consequently end up paying a little more in taxes. But on the other hand, I'm eligible for a larger and more significant loan. It's called leveraging. We can talk about that in another video. And it's because I'm displaying a higher income. It's extremely crucial that you make sure to organize this and prepare it in advance so you can know what you actually qualify for. The next step is to speak with a lender or mortgage broker before you take any other action. The reason being, and I swear this is going to happen, it's happened to me, you're going to leave, begin viewing homes, you see the most amazing home, and it's unquestionably perfect, and then you'll visit the mortgage broker and find out that house is over your budget. So you're unable to afford it, and you'll be brokenhearted. I know. Emotions get into play. You can't expect a bad experience, so look for the good in it. Have fun instead. So here's what to do. First, provide a lender with all your paperwork, tax returns, banking statements, check your credit score. If you know the score, it'll provide you an estimate of your economic viability. Credit scores merely allow lenders to be confident in your payment of the loan for the property. Regardless of the result, they will be able to enter every number and tell you roughly how much you qualify it for right away, as this is crucial. One of the reasons you do this is so that you're aware of what you can afford, so you won't need to waste time, anyone's time, including your own, by viewing something that is simply too expensive for you. Look at things in a price range lower and higher than what you've been approved for to learn the market in your desired area. You'll really appreciate the time you've saved, and time is money. Take my word for it, because this is like 25 years of experience at this point. At this juncture, and it happens all the time, you discover a property that's worth investing in. Remember, there's probably 10 other people also desire it as much as you do. It's crucial that you have the ability to make an offer quickly, and if they accept, be able to follow through. Otherwise, you can incur costly penalties. Timing is crucial for your first real estate investment. The sooner you can take action, generally speaking, the better. You determine the precise amount with the lender. What can you be eligible for? To begin, start looking at all the homes for sale. This should be the enjoyable part. Consider everything within your price range and then increase it by 15%, just so you can see properties with slightly higher value, but also lower. As you look at more properties, the better you get at assessing the value when it comes to purchasing genuine rental properties. Like for me, when I'm looking for a new investment property, I'll look at every single thing around my price point so that I can tell when I see the right one. Immediately, bam, an offer's made. You're going to have to view more than 30 homes. This gives you a better understanding and the reasons behind the pricing. Always make comparables. Write them down. Then determine what improvements are needed for increased value and occupancy. Also, what improvements are not appropriate for the property. Consider how reasonably something is priced. You really get a good understanding after viewing more than 30 homes. If you don't do this, you might come across the ideal property but simply fail to notice it because you have nothing to contrast it with. To find the right property for you in your budget, if it is low, then I would advise searching outside of your state. I live in an expensive neighborhood, and rentals here simply lack cash flow. So out of state might be an option, depending on your needs. It was a good choice for me. I was able to buy in other states near universities. I like purchasing homes where I can see what is happening today. I know where people are moving. I'm aware of trends in where to invest money. I can see how the region is growing. Are there lots of new jobs in the area? I'll drive to the area and ask locals questions as it gives me first-hand information. And as a result of that, I believe I have an edge over somebody else who's purchasing properties blind. It is now commonplace to look outside your city or state. It can have other local costs, so make sure to find a good realtor wherever you're investing. There are deals to be had everywhere. Take your time and do your due diligence. I'm just saying that other locations do have their own risks unique to that area. You must fully comprehend precisely what you're investing in and purchasing. When it comes to me right now, I don't invest in cheap real estate. I don't invest in luxury real estate. Not too far on the bottom and not too high. I do medium price range is what I choose. If there's anything like a median price range, the median encompasses this entire range from low to high. My preferred route is low to middle, if that makes sense. The section just below the current average price in the area for me. So I can focus on the biggest buyer pool. My reasoning is simple, because lower middle for me indicates there's typically a little more space or room for potential gain if I upgrade it and price increases. As well, it usually commands a good rent and usually better tenants. When it comes to leasing the property or renting, I'm reasonable, and in general I look for families. If the property is near a school or a university, I will discover many more tenants who want to reside there. I rarely invest in condominiums. There isn't much room for an upside. No additional square footage is usually possible, or many upgrades. No increase in value. And there's only so much you can do. Also, your upgrades are dependent on the housing authority's whims. Also, there are housing authority dues, condo fees, etc. that just eat into your profit. I tend to stick to single family or fourplex, triplex, duplex, 2 to 4 units. And the reason is that you can still obtain conventional finance. Plus, you can live in one of the units for free and possibly have the tenants pay off your mortgage. It is much simpler to obtain a mortgage with commercial financing, however, once you have more than 5 units. This is because they don't use your income. They look at the cash flow of the property, although you have to have a higher percentage down, more like 30%. And if you choose to sell sometime in the future, it could be easier to find potential buyers or investors. You want to make sure the property you purchase will cash flow. Almost 98% of homes are terrible and can't cash flow, especially in wealthy and rich areas. If you buy a place and it doesn't have cash flow, you'll lose, or you'll be on the hook for things you don't want to pay for. If they're not cash flowing, then they're not a good investment. Make sure that this is a wise investment. Then what I do is look for a similar house in that neighborhood on Craigslist. If you're in Canada, Kijiji. Look for market value rents for you. You can utilize websites like Zillow, Trulia, Redfin. Look around and discover what other houses are renting for. That'll be your basis to determine actual rent for the property in order to comprehend proper cash flow. To begin, you must figure out all the expenses on the property. The initial thing to do, how much do you have to put down? Then you'll think about what your mortgage is going to be. And after that, you must think about your interest rate. I anticipate the loan terms will be amortized for about 30 years. So if you're aware of these elements, you can plug them into a mortgage calculator. There are lots of them on the internet. Mortgage calculators can give you the information on a fourplex and a single family as well. So let's look at a $400,000 piece of real estate. In the event that you put 20% down, your monthly payment would be $1,700. You'll have to determine what your property tax in your state are. And in California here, it's approximately 1.2% of the purchase price. So based on that, it'll be $4,800. So $400 per month. As a result, you'll need to be covered by insurance. And my properties typically cost anywhere from $100 to $150 per month in insurance. So we'll add that to the total. I advise in getting in touch with your insurance representative just to learn a rough estimate what your insurance would be. Also, you'll find a lot of other unexpected costs that arise. That could be a random pipe breaks, you have to call a plumber. Regardless, you'll have to pay for it. Landscaping, snow removal, or whatever else that you have, a few additional costs to add on. Additionally, I typically just throw a $200 a month prudent reserve on top of that. Also, every now and then, there will be a vacancy. Your tenants will occasionally move out, and there will be some vacancies. That is another cost out of your pocket, so be prepared. So add another $150 a month on top of that, just to be safe. On average, this implies that on a property that is worth $400,000, probably on average, the expenses will be $2,600, which includes your mortgage payment, which has to get paid each and every month. Which also means that making the property profitable, you'll need to increase your income compared to that in rent. So let's say for this demonstration that your $400,000 property will command a rent of $3,200 a month, which implies that you should have approximately $800 cash flow per month with an $80,000 down payment investment. That's a 24% return on investment in the first year. Now, in addition to the $800 cash flow, here in Los Angeles, properties have risen by more than 14% in the last year. So 14% of 400,000 is 56,000. Add 9,600 to 56,000, and that's the return in the first year. 65,600. That's an 82% return on the 80,000 invested. I would never ever suggest purchasing a home without cash flow. The absolute worst case scenario is break even. The reason because if there's any vacancies or issues, you'll have to have the income to cover any and all costs. In the beginning, it is best to manage your property so as not to incur costs. And if you're a handy person, the better, as trades can be expensive. Learn to become a handyman. Fix all your own pipes. Also, if there's a garage, you can rent it out separately for an additional $200 for storage. This means more cash flow. If you're just getting started, this is the safest bet to always have cash flowing properties. Now you need to start locating a property that will generate cash. Finding cash flow properties is like finding a needle in a haystack. I've probably seen over 1,000 properties in different areas in the last year, and perhaps only a few of those actually cash flow, which is why it is crucial to be patient, to really stick to the numbers and understand what is reasonable to purchase. Don't buy with emotion, only buy with numbers. Sometimes a house that's been on the market for some time could accept a lowball offer, and if it would cash flow, see what happens. Keep this in mind, every property will cash flow at a fair price. So don't be afraid to occasionally make some reasonable low offers at a price that will cash flow. And if the owner rejects the offer, so be it. It's okay. But every property will cash flow if the price is right. The more offers you do, the better you'll get at doing it. It's pretty cool. It becomes quite fun. Search for properties that only require cosmetic renovations, or as I like to call it, lipstick on a pig. Whenever I purchase something, I can see all the benefits of a good paint job or landscaping or just little touch-ups in the bathroom. Your ideal home should not have any hidden major repairs such as roof, foundation, plumbing, or electrical systems. Make sure to get an inspection as part of the closing. There you go to the successful formula for buying your first rental property. Wait, do you want to make $500,000 over the next 10 years passively? Then do the above calculation and just hold your rental property and you will have yourself $500,000 in equity. Now imagine if you had 10, 20, or 50 such properties. You're on your way to becoming wealthy. Please subscribe, like, hit the bell icon for more videos for a better life. Thanks for watching and being part of the we. Love and light, friends.